So there's a lot of pros that come along with starting your own business, from the freedom to work when you want, the flexibility to pick up the projects you want, and really just the overall ability to be your own boss. But one of the things that is not a pro to working for yourself is in fact a big con is the taxes. So your tax situation gets exponentially more complicated once you become self-employed compared to when you are an employee. There's a lot more layers of complexity that you need to know about. And so in this video, I'm going to be explaining to you exactly how the system works. If you are self-employed, an influencer, a gig worker, etc., you know exactly how the system works, how your tax bill is calculated, and this stuff isn't just one big black box to you. So a brief roadmap of what we're going to cover. First, we're going to talk about how tax brackets work. Then we're going to talk about how to actually calculate your tax liability. So the exact formula that the IRS uses, you're going to be able to fully understand it. We're going to break it down step by step by step. You'll know exactly what goes into calculating your tax liability, and more importantly, how to influence those factors in order to reduce that tax liability for yourself. We're then going to talk about how income taxes are different for self-employed people, because there's a number of different layers that you add to the puzzle when you are self-employed versus when you're working a job. Because when you're working a job, your employer is kind of taking care of a lot of those intricacies for you. So as a self-employed person, you take over some of that responsibility. Next, we're going to talk about when income taxes are due for self-employed people, because it's actually different than if you are an employee. Then we're going to talk about the tax deductions that you can take as a self-employed person. This is a big value add for a lot of people. Okay, this is one of the big pros to being self-employed, is all the additional deductions you have available to yourself. So definitely stay tuned for that. And then the last thing we're going to cover is how to actually pay your taxes, how to give the IRS the money that they are asking for. So as always, there's timestamps to all of these down in the description below, because this is a bit of a more lengthy video. This is really going to be pretty much a whole course for you on income taxes, exactly how they work and everything that you need to know, so that by the end of this, you are fully prepared to go out there and understand all the stuff that's going on, whether you choose to do them yourself or whether you choose to hire that out. You'll at least know all of the ins and outs of what is actually happening, so you're not just kind of in the dark on how income taxes actually work if you are working for yourself. Now, I do want to make one quick ask here. So if you can just take a second here, put away your distractions, turn your phone off, unless you're watching the video on your phone, obviously, but turn your phone off, put your distractions away, grab a drink, maybe a pen and a piece of paper, and just really dedicate some attention to this video for the next few minutes. Because if you watch this video, you're not going to need to watch 10 other videos about how income taxes work if you're a self-employed person. It's really just a one and done solution for you. So make sure to pay attention to this video. Maybe if you got to take it in sprints, okay, watch a little bit now, pause it, come back later. But I'm very confident that if you can dedicate some serious time to this video, it's really going to pay off and you're really going to learn a ton. So let's dive right on into it. Real quick disclaimer here. This is not tax advice, nor does it apply to your particular situation. This is for informational purposes only, and don't fill out any tax or legal paperwork without talking to a professional first. So now that that's out of the way, let's talk tax brackets. And this is really the first step to understanding how income taxes work, because they're based on the idea of tax brackets. If you don't get this, you're not going to understand anything else. So very important part to pay attention to. And how most people think tax brackets work is they think that, okay, whatever tax bracket I fall into, whether it's the 12% or the 22% or the 28% or whatever tax bracket I fall into, I just multiply my income by that number, and that's going to spit out how much I owe in taxes. Now, there are two huge things that are wrong with that, okay? That is not at all how tax brackets work. And so let's dive into how they actually do work so that you don't make that common mistake. Because one thing that I hear a lot of people say is oh, I don't want to get a raise because I'm afraid that's going to bump me up to the next tax bracket and it's going to cost me more than the raise actually is. That is literally impossible to do, okay? You can never get a raise that costs you more than it is netting you. So never be afraid of getting a raise because it's going to bump you to a higher tax bracket. That's just silly. And so the basic concept here is correct though. Okay, so the higher amount of income you make, the higher tax bracket you're going to be in, the more taxes you're going to pay, okay? The US has a progressive tax system, which means that as you make more money, you're paying a greater percentage of that to taxes. However, it's not just a flat percentage that's multiplied by your income. And I'll have a full video coming on tax brackets soon, but for a simplified example in this video, the two things you need to know is that one, your taxes are not based on your income, they are based on your profits as a self-employed person, okay? Because if you have expenses for your business, those are likely going to be deductible. And we'll talk about what that means later and how you can actually determine if certain expenses are deductible. But the essence is that you're going to be paying taxes based on your profits, not based on your total amount of income, because you can write things off, get those deductions, and lower your income down so that it's not all taxable. The second misconception is that it's a flat rate that's applied to all of your, in this case, profits. Okay, so you're looking at your profits, say you made 100 grand in profits, and say that puts you in a 30% tax bracket, okay? Most people would would think, okay, I'm paying 30 grand in taxes. Not the case at all, okay? And I want to show you a quick visual example of this because it's a little bit difficult to explain without having kind of some visuals to go along with it. So essentially what's going on is, say we've got our profits right here, okay? These are our profits for the year. We've got some cold hard cash. This is our profits, okay? And these guys are our tax brackets, okay? So let's say that this is our 10% tax bracket. I'm just making up numbers here. These aren't actual tax brackets, but say this is your 10% bracket and say this guy can fit $10,000 in it, okay? So we've got this guy. We've got our 20% bracket right here. Say this one can fit $40,000 in it. Okay, and then we've got our 30% bracket right here. Say this is the top tax bracket, so this just fits in all the rest of your income. It's a bottomless bucket, okay? So what we're going to do is we're going to take our profits right here, okay? We got these profits, and say we made $60,000 worth of profits for the year. We got 60 grand in profits right here. What we're going to do is we're going to start putting those profits into the lowest tax bracket, our 10% tax bracket. So we're going to take 10 grand of our money, boom, and our 10% tax bracket is full with 10 grand. So we're going to set that aside. We'll come back to that later. Now we move on to the next tax bracket. This is our 20% tax bracket. It can fit 40 grand in here. So we're going to take 40 grand of our income and we're going to plop it right into this tax bracket. Okay. Lastly, we have got our 30% tax bracket, which is the last one. This is going to take all the rest of our income. Remember, this is a bottomless bucket. It can take everything else you got left over. So boom, here's our last 10 grand. And so now we have put our money into all of our tax brackets. So what does this even mean? We have put money into our tax brackets, and now we're going to go back and actually figure out how much we owe in taxes. So we'll start off with our lowest tax bracket, so our 10% tax bracket, okay? So in this bucket, we put $10,000. It's going to be taxed at 10%. So 10% of 10 grand is $1,000. So because we put 10 grand into this bucket, we're going to be taxed $1,000 for that. Next, we'll move on to our 20% tax bracket. So in this bucket, we'll go look, we'll see, okay, we got 40 grand in this bucket, taxed at 20% is going to be another $8,000. So now we've got $1,000 from our 10% bucket. We've got $8,000 from our 20% bucket. Now we go to our 30% bucket, we find another 10 grand in here, and that's gonna be taxed at 30%. So that's another $3,000 in taxes. So although we ended up in the 30% bracket, that's the bracket that we made it to, that is not where all of our income is going to be taxed. Because remember, we had 60 grand in income and we're paying 1,000 plus 8,000 plus 3,000, which if my math holds out, that's $12,000, which is not 30% of $60,000. That would be $18,000. So hopefully that makes some sense. Hopefully you have some clarity on how tax brackets work right now, because that is going to be very crucial to the rest of this video. So just know you're basically filling up the buckets. Once the bucket is full, you move to the next one, and whatever bucket you end in, that's like your tax bracket, but that's not where all of your income is taxed. It is taxed all along the way. So now that you understand that, we can move on to the actual formula that is used for calculating your income taxes as a self-employed person. We're going to dive into my computer so I can show you that formula and break down every step of the way. All right, so here we are in my computer, and as you can see, this is the basic income tax formula for individuals. We're gonna start off at the top, and this says all income, okay? So this could also say gross income. Gross income, all income, same thing. Basically, all of the money that you receive over the course of the year from your business is going to be included right here. So that is what you start off with, very, very simple there. Next thing we're looking at is the above the line deductions. So this is probably where you're starting to be like, okay, I knew what all income meant. I do not know what above the line deductions means. Well, it's actually pretty straightforward. So the line that they're referring to is just this line right here, the line above the adjusted gross income. That's kind of an important number that we'll get to in a little bit, but this is the line they're referring to if you're wondering what that means. So above the line deductions before your adjusted gross income. What these are, commonly, these are going to be your business expenses, your travel expenses, your dining expenses, basically all of the things that go into running your business. So your supplies, your software, your employees, all of that stuff is going to be an above the line deduction. We'll talk more about these later, but basically just know that these are subtracted directly from your income to come up with your adjusted gross income. So essentially what we're doing here, a very, very simplified explanation of what we're doing here is we're going from your income to your profits, okay? Because most of the things that are above the line deductions are expenses from your business. So there's some other ones we're gonna be talking about a little bit later, but just know that kind of what we're doing here is we're taking your income, we're taking off your expenses, we're getting to your adjusted gross income. So adjusted gross income, here we are. This is a very important number for kind of eligibility for different kinds of tax credits and deductions and whatnot, but you don't really need to know too much about it for the purposes of this video. And if you're a self-employed person filing your taxes, you don't need to know too much about your adjusted gross income. But the next thing that's important here is we're subtracting out the standard deduction or your itemized deductions. And these are also sometimes called your below the line deductions because they're below your adjusted gross income. So these are your below the line deductions, and you get to choose if you want to take the standard deduction or itemize your deductions. Now, most people are going to be best off with the standard deduction, especially if you are a young person, young entrepreneur, influencer, whatever. You're probably going to be best off with the standard deduction. But kind of how this works is you're going to add up all of your itemized deductions. And if they're more than the standard deduction, you take the itemized. But if they're less than the standard deduction, then you take the standard deduction. Now for the 2021 tax year, the standard deduction is $12,550, which basically means if your itemized deductions are less than that, then you would just take the standard deduction and you can just remove that directly from your adjusted gross income. So you can just take a $12,550 deduction for being a human being and living in the United States, which is pretty sweet. But let's talk about itemized deductions really quick. So the big itemized deductions are going to be charitable contributions, home mortgage interest, and state and local taxes. So if you are paying more in state and local taxes, home mortgage interest, and charitable contributions than $12,550, then you would likely take the itemized deductions because they're going to be more. But if you're paying less than that in those three things, then you're probably going to be on the standard deduction. Now, exemptions don't really exist anymore, so you don't need to worry too much about those, but that's going to pump out your taxable income. Now, there's one other deduction in here that is kind of important to mention, very complicated. So the purposes of this video, we're not even going to get into it. I'll have a future video coming soon on this topic, but that is the qualified business income deduction, or the QBI deduction. So that falls in kind of right here. So right below, right where exemptions kind of are, is your QBI. And so you don't really need to worry too much about that for now. But if you are running a business that is organized as a pass-through entity, which is basically an LLC or an S Corp or a sole proprietorship, then you are potentially going to be eligible for the QBI, or qualified business income deduction. Again, video coming on that soon, so don't worry too much about it for now. But that's going to pump out your taxable income. Okay, so we've taken our gross income, all of our income, we've subtracted out our deductions, both above the line and below the line, and now that gives us our taxable income. So now this is the amount that we're actually going to be taxed on. And what we're going to do now is we're going to take our taxable income, okay, and we're going to apply our tax brackets to it. Okay, so that whole exercise we did earlier with the boxes and the money, that is what we do now. So say our taxable income came out to $60,000. That was what I did earlier. That was putting that $60,000 into the different buckets. That gets you your tax liability, okay? And so tax liability should honestly come like right here above your credits and other taxes, because you have your tax liability. So with our case, we had a $12,000 tax liability. Then from there, you can subtract out any credits or other taxes that you have already paid. So in the case of working at a job, other taxes is going to represent withholdings. So on your paycheck every 2 weeks as an employee, you are going to have a certain amount withheld for taxes. Now, that's not the case if you are self-employed. You have nobody withholding money for you. You are just getting the money, and then you're going to need to pay it to the IRS. But if you are working a job, you're going to have withholdings, and those are going to subtract out from your tax liability. So essentially, you've got your taxable income, you apply your tax brackets, that gives you your tax liability. From there, you subtract out your credits and your withholdings. That's going to give you the total tax that you owe or the refund that you are entitled. And basically, when you're getting a refund, all that means is that your withholdings over here were more than the tax you actually owed. And so you're just getting money that you already paid in refunded back to you. So hopefully that all makes sense. Okay, the premise is you take all of your income, you subtract your deductions, that gives you your taxable income. You apply your tax brackets, that gives you your tax liability. From your tax liability, you subtract out your credits, and that gets you the tax that you owe. Now, that is solely your income taxes, but as a self-employed person, you're also going to have self-employment taxes on top of that. And so I'll have a whole video coming soon on how self-employment taxes work, but for now, just know that this is income taxes only. Self-employment taxes is on top of all of that. But so far, what I've talked about has really just been income taxes as they apply to everyone, okay? How are they different for self-employed people or influencers or entrepreneurs? Because they are very different if you are self-employed. Now, the actual mechanics of them are totally the same. So that formula that I showed you applies whether you are an employee or an employer or a self-employed person or whatever. That formula does not change, but pretty much everything else does change. So the first thing that I mentioned with withholdings, so those absolutely change whether you are an employee or an employer. So if you're an employee, every 2 weeks on your paycheck, your employer is taking off some income and sending that off to the IRS on your behalf, okay? And that's based on the W-4 form that you filed with your employer when you were hired. On that form, you might remember putting some ones and some zeros in some boxes, and then based on the number of ones and zeros you put in those boxes, your employer says, okay, we're gonna send off this percentage of your money to the government every 2 weeks in order to pay for your taxes. Now, there are pros and cons to getting your money withheld for you. The pro to getting it withheld for you is that you don't have to worry about it, okay? Like you just show up on tax day and you say, okay, here's how much I already gave you, how much more do you want, or how much do I get back? So it makes taxes super easy because you don't have to worry about literally anything. You just show up on April 15th and you say, hey, IRS, what did I give you? What did you need? And what's the difference? So that makes things super easy. But on the flip side, okay, as a self-employed person, since you don't have to do that, you have more money at your disposal to reinvest in your business because you don't have to send that money off to the IRS. You can hold on to it and use it yourself to reinvest in your business, maybe do some marketing, some advertising, whatever you want to do, hire some more people, who knows? But you have that money to work with instead of it sitting in the IRS's bank account. Now, the con to that is that you're going to be hit upside the head with a giant tax bill if this is your first year as a self-employed person and you were not expecting it, okay? Because with no withholdings means that instead of slowly chipping away at that tax bill every 2 weeks, you're just getting hit with one major tax bill that might blindside you a little bit if you were not prepared for it. So for that reason, as a self-employed person, it's likely good to set aside some income for yourself on a regular basis. So when tax time does come around, you're not just totally surprised that you owe thousands of dollars, tens of thousands of dollars to the federal government and you have nothing to speak of in your bank account. So personally, what I choose to do is out of my gross income, okay, so all the income that comes in before any expenses, before anything, I take 25% of that, I put it in a separate bank account with a separate bank that I can't even see. And it just sits there until the IRS asks me for some money. And then I can just go to that bank account, pull some money out and give it to them. And usually it's enough money in there. Sometimes it's not enough money in there. So I got to find some more money. But usually that is a pretty solid system for me. And that's really going to depend. Your percentage is totally going to depend on a number of things, including your tax bracket and the profit margins of your business. Okay. Because if you're running a business with lower profit margins, then you're going to need to take a lower percentage of your gross income. But if you're running a business with very high profit margins, then you're going to need to take a higher percentage of your gross income in order to pay your taxes. So that's one thing. And the second thing is, the tax bracket you're in. So if you're in a higher tax bracket, you're obviously going to need to set aside more income to pay the government. They're going to want more of your money. So you got to keep that stuff in mind when you're thinking about that percentage. In general, it's a relatively safe bet to go like 25 to 30% of your gross income to start with. But then after you pay that first tax bill, you'll be able to adapt that and see, okay, I saved too much, I didn't save enough. I mean, you always want to, saving too much is never a bad thing, but if you don't save enough, then you're really going to need to adjust your system so that next time the tax bill comes around, it is not quite as much and it doesn't really surprise you as much. Because one thing you don't really want to do, some of my buddies do this, they put their taxes on a credit card. And so that's, you can do that if you want to. We'll talk more about that in a little bit. But personally, I prefer to just pay my taxes in cash just because I want to know I don't have that peace of mind that, okay, I have the money right here, right now. Here you go, IRS, we're done, we're settled. I don't have to worry about anything. So for me, I prefer cash, but you can choose to pay with a card. We'll talk about that later as well. But now another big difference for self-employed people when it comes to paying their taxes is when they're actually due. So unlike being an employee when your taxes are due on April 15th every single year, as a self-employed person, you actually get the pleasure of having 4 tax days every single year. So when I first started working for myself, I was very surprised to learn that I had to be paying my taxes 4 times per year instead of just 1. I thought 1 was good enough, but 4 was what I was going to be doing. And I've got a whole video on actually this system. It's called quarterly taxes, paying your taxes quarterly. So you can check that out up here somewhere. So that'll give you a full kind of scoop on this. But the kind of simplified version is that in the United States, we have what's called a pay-as-you-go system. Okay. And with a pay-as-you-go system, the government basically says, okay, we want money from you on a periodic basis. Okay. Because we have to keep the lights on. We got to keep our employees paid. We got to keep everybody happy over here at the government. So we have to get money from you on a regular basis. We can't just rely on a one big boom, one big check once a year. That doesn't work for us. So we need you to pay as you go. So that's what we're working with here. And now let's talk about who's required to actually do this, right? Because obviously if you're an employee, you don't have to pay quarterly taxes because your employer, like we said before, is withholding income for you out of every single paycheck. But as a self-employed person, obviously that's not happening. So according to the IRS, if you're going to owe more than $1,000 in taxes for the duration of the year, okay, so $1,000 in income taxes, and you can actually calculate that using the formula that we used earlier. So you can scroll back through the video, find that formula, and use that to actually see, okay, am I going to owe more than $1,000 in taxes or not? If you are, then you are legally required to pay your taxes on a quarterly basis. It's not an option. There's no flexibility here. It is, you are legally required to do this. Now, believe it or not, some people actually decide not to do this. I know a fair number of people that choose not to do this and they are self-employed. And what happens in that case is that they feel that, okay, if I were to hold on to this money myself, I can be more productive with it than the IRS could. Okay, I could reinvest it in my business, do some marketing, hire some people, etc., and I could be productive with this money rather than just letting it sit in the IRS's bank account. Which, there's some credence to that. Like if you have a business that's growing rapidly, chances are you could make a decent ROI on that money. But unfortunately, that is against the law because you are legally required to pay these things. And so what's going to happen if you don't is you're going to get hit with some taxes and penalties. Okay, so the IRS is going to start charging interest as soon as you don't pay your taxes. So if you were supposed to pay your taxes taxes, say on April 15th, and you don't, okay, interest is going to start accruing on that balance, in addition to some taxes, potentially some penalties as well, depending on your situation. So there are costs associated with not paying your taxes on time. Now, if this is your first time kind of missing or being behind, or not even knowing you were supposed to pay your taxes quarterly, you might be able to write a nice letter to the IRS and get them to forgive those taxes, penalties, interest, etc. But if this is not your first time, chances are that's not going to happen for you. So you can kind of weigh this yourself if you want to not follow the law and not pay your taxes quarterly. That's totally, you could do that. Wouldn't recommend it. I personally pay my taxes quarterly, but it is a thing that some people choose to do because, again, they feel they can be more productive with that capital than the IRS could. And again, you totally got to weigh the cost there, okay? Like in some cases, these penalties can range upwards of 10%, 20%, 25%. So you really have to weigh the cost there. Also, there's the potential for them to increase the risk of you being audited. So personally, like I said, I think it's just safest to pay your taxes on a quarterly basis if you are legally required to. But if you're not legally required to, then you don't really have to worry about that. If you're going to owe the IRS less than $1,000 in taxes, then you don't really have to worry about that. Well, now that you know that tax day is coming up, regardless of when during the year it is, let's talk about how you can actually reduce those taxes for yourself. And the biggest way to do so is through deductions. Okay, so one of the pros that comes along with being a self-employed person is that your ability to deduct things on your taxes goes up dramatically, because as an employee, there's not all that much that you can deduct on your taxes. I mean, there's things like student loan interest. If you're contributing to a 401k, those are things that you can deduct as an employee. But as a self-employed person, you've got a whole wide range of things that you can deduct on your taxes. I've got a whole video coming up on this as well, so make sure to stay tuned for that. But in this video, I'll go over like 3 of the most common tax deductions you can take as a self-employed person. Now, the biggest one of which is your business expenses. Okay, so like I was talking about earlier, these fall in the above the line deductions section, as we were talking about with that whole tax formula that we had going on here. And the rules that surround business expenses, okay, because there's definitely a lot of flexibility in terms of what can be considered a business expense, depending on who you talk to, what kind of CPAs, what kind of tax planners you're talking to. They're all going to tell you something different. Okay, but what the IRS is going to tell you is they're going to tell you that if it is ordinary and necessary, then it is a business expense that is deductible. Now, obviously, those terms are very broad. So how do you know if something's ordinary or necessary? Well, one of the best ways to do so is to just kind of think about it from an outside perspective, okay? Because what the IRS is going to do, if they do audit you, they're going to go through all of your expenses. And they're going to say, okay, was this ordinary, necessary? Boom. Was this ordinary, necessary? Boom. They're going to go through all of those. So think about, from the IRS's perspective, if they were looking at this expense, would they classify it as ordinary and necessary? And one of the things that's important to think about here is that ordinary and necessary is relative to your actual business size and the type of business that you're running. So for example, say you're running a small business, okay? Say you're making like 20 grand in profit per year on Shopify. And then you go out and spend $10,000 on a first class plane ticket, okay? That you classify as a business expense. Odds are IRS is going to look at that $10,000 expense, see you spent 50% of your taxable profits over the year on a first class flight, and they're going to say that was not ordinary, nor was that necessary. Okay, if you're making 20 grand a year in profit, you should have been flying coach. So things like that. Okay, so think about, from the IRS's perspective, if they look at this, would they clearly understand that it's ordinary and necessary? Now, if you're a YouTuber and you buy like a camera to record your videos on, sure, that's probably ordinary and necessary. If you're a TikToker and you buy a ring light, yeah, that's probably ordinary and necessary. But if you're doing very extravagant things, if you're buying things that are not even related to your business, you have to really put yourself in that outside perspective of the IRS that they want to get paid as much as possible. And so they're going to assume that nothing qualifies as a deduction. So you're going to have to make your case for these things. So if you can't make a strong case for it, probably not a great idea to claim it as a deduction. And if you're on the fence about anything, make sure you reach out to some kind of tax planner, CPA, etc., that can really give you some clarity on how these things have been defined in the past, because there's a ton of past court cases that kind of go over how the IRS has ruled on different things. So looking at those can be super helpful for you. And if you talk with a professional that's familiar with your area of business, then that's going to be a lot simpler for you to just like get those answers right off the bat. Now that's the big one. There's also 2 more that I want to cover in this video. Next of which is retirement contributions. So as a self-employed person, you actually have a whole host of retirement plans that you can choose to set up for yourself. And so these are going to basically allow you to get a tax deduction for paying yourself, which is dope, okay? Like you get a tax deduction for planning for your future, putting money into your retirement account. Very, very nice. Now, the 2 most popular types of retirement accounts for self-employed people, you've got your SEP IRA and you've got your solo 401k. And these are the two most common types of accounts. There's kind of a lot of pros and cons between the two. So you might have expected this by now, but I'm going to have a future video coming out on SEP IRAs versus solo 401ks. So you can really compare and contrast those two, because personally, I did a lot of research between these two last year and I settled on the SEP IRA, but then this year I'm actually going to transfer into a solo 401k. So there's a lot that goes into both of these types of accounts, but what you can essentially know is that as you're putting money into these types of accounts, you can deduct that on your taxes, which is super nice. Again, like I said, you're basically getting a deduction for paying yourself. Doesn't get much better than that. Now, the third one that I want to cover in this video, third deduction, is the home office deduction. Now, if you have a place in your home that is dedicated solely to working, now this can be in a house or an apartment, but a place in your residence that is devoted solely to work and nothing else. Maybe you're holding client meetings there. Maybe it's your office where you record videos, something like that you could potentially deduct a portion of your rent, of your utilities, of your electricity, like of all of these expenses that go into your house. You can potentially deduct a percentage of those based on the percentage of your house that is occupied by this office space. So there's a lot that goes into the home office deduction in terms of who can actually claim it, how much you can actually claim. And so I don't want to get too in the weeds on that in this video. But again, I will have a video coming soon on the home office deduction, kind of breaking that down step by step. So as you can tell, a lot of videos in the pipe when it comes to taxes, because I'm super jazzed about this stuff lately, because this stuff is super important for self-employed people, and a lot of people just don't know this stuff. Okay, so definitely video coming soon on that, so stay tuned. So those are your primary deductions. Okay, you've got your business expenses. Again, this is going to be the biggest one. Okay, all of your subscriptions are going to fit into this, supplies, equipment, like all of that stuff is going to fit under your business expenses. And so those are all your deductions. Okay, so now you kind of have the whole picture. Okay, you've got you know the formula. Okay, you know how tax brackets work, you know the formula, you know when your taxes are going to be due, and you know what some of the best deductions are to be taking. Now, let's tie it all together and talk about how to actually pay these things. Okay, once you know how much you're supposed to be paying, if you know you're supposed to be paying quarterly or not, let's talk about how to actually get the IRS their money. How do you deposit that cash into Uncle Sam's bank account? Well, first off, I just want to tell you that there's a lot of scammers out there that are going to tell you that they are the IRS and that they want their money, and you should not listen to those people. Okay, if you get a call from someone claiming to be the IRS, I'll tell you what, they're not the IRS and they do not need any of your money. They are probably doing just fine. So hang up on them, tell them to have a nice day, or don't, or just tell them to go away and put that aside, okay? Because that's not how you give the IRS their money, okay? If you want to give the IRS their money, what you do is you go to the IRS's website, which is irs.gov/payments. This is where you're going to make your tax payments. Do not make them anywhere else. This is the place where you should go. Now, once you get to that website, you're going to have three main options for how you can pay your taxes. You can either mail it in, which I don't know who uses the mail anymore, so don't do that. You call them and make a payment over the phone. I wouldn't really recommend that. Your third option is to pay online, which is what I personally do, and I think that's just the best way to go. I mean, if you're a young person, like, why would you get on the phone with someone? So I would recommend paying online. It's just the most streamlined way to go. If you're paying online, you get to either pay directly from a bank account, which is personally what I do, or you can use a credit card. And if you use a credit card, you're going to get hit with about a 2 to 3% fee on that. So you're just going to have to weigh the pros and cons there, whether it's worth it, how much your tax bill is actually going to be, and whether it just makes sense to just pay from your bank account or not. So personally, like I said, I pay from the bank account. I prefer not to do any debt when it comes to pay my taxes. I don't want to pay any fees. So bank account is the way to go for me. Now, in terms of actually going through the process and paying on the IRS's website, it's actually really, really simple. So first you have to make an account. Okay, that's a pretty simple process. You just go to create an account. You sign up with your email, password, social security number, all that good stuff, so the IRS knows who you are. Then what you're going to do is you are going to press the Make a Payment button, which is on the irs.gov/payments website that I mentioned earlier. Once you click on that, you're going to start going through the process. It's all very straightforward. The only place where people sometimes get caught up is under reason for payment. So there's a ton of reasons in here, like a couple dozen reasons why you might be paying them. But the one that you're going to want to choose is estimated payment. If you are making a quarterly tax payment, it's also called quarterly estimated tax payments. So just click on the button that says estimated payment and complete the process, go on your way, and it's all very straightforward from there. So at this point, congratulations, you now know more about income taxes than most other self-employed people out there. I'll tell you what, most people out there who are self-employed, influencers, entrepreneurs, whatever, they don't know much about taxes, okay? From the people that I've talked to, they don't know much about taxes. So if you've made it all the way through this video and you paid attention, you took some notes maybe, you now understand how these taxes work if you are a self-employed person. And even if you do decide to hire this stuff out, which is probably not a bad idea, it's good that you now understand how the mechanics of this stuff works so that when you're talking to your accountant, your tax professional, whatever, they now can communicate with you in a way that you will understand and you will know what the heck they're talking about when they mention your above the line deductions or your adjusted gross income income or your gross income, things of that nature. You now understand what those mean. And if you don't, maybe take a second pass through the video, jot down some more notes so you'll be prepared for that conversation. Also, do consider subscribing so you don't miss those videos that I mentioned earlier. All those videos that are coming down the pipe when it comes to taxes and finances for self-employed people or influencers. You're definitely not going to want to miss those, so make sure you stick around for them. And also comment below with any other topics you would like to see me cover when it comes to finances for self-employed people. I'm curious what's on your mind and would love to make a video about that, helping you out. So now the next thing you should do is click the subscribe button down below and check out this video over here where I go in depth into quarterly taxes, exactly how those work, because in this video I wasn't able to go fully in depth on those. So make sure you check that video out and I'll see you over there.